Hey, good afternoon, everybody. Thanks for checking out this video. There's a lot of information here, and I'm just trying to paint a quick picture as to what I do. I have several of you guys and some potential investors that are looking to understand multifamily, understand real estate. It took me, I've accelerated the last 9 months, but it really took me a couple of years to really understand all the nuances and what's important as an investor to look at these types of deals. So a quick insight into my kind of daily life, and it's super exciting. I love talking about this stuff. There's a lot of good opportunities to build long-term wealth in this, and I'm excited to share with you. So please, give me some feedback. I'd love to just kind of better understand if this data means anything, if it's, if you're understanding it, if you have questions, please reach out. So this particular property is in Tucson, and I won't share the exact address or anything like that, but it was a deal that we did look at and we chased. Unfortunately, we didn't win it. We came in second, and it was a little gut-wrenching, but it's okay. There's more deals out there, but it is a very good model of exactly the kind of property that we want to look at. And why do we want to look at these kinds of deals and those locations? So before we look at any kind of property, we got to figure out the market. And so our company is focused purely on about 3 markets, right? Tucson, Arizona, Phoenix, Arizona, and Albuquerque, New Mexico. There are a few other ancillary kind of areas we're looking at, but I spend a lot of time. Of the 550 properties that I've underwritten, they've all been in those 3 markets. And of the 550, we've likely underwritten and actually put offers out on about 50 of those. And only 3 or 4, right, really got into the top 5 as far as offers that were in the top 5. And then, we haven't been able to win one yet, but we've gotten close. And so that's speaks to a couple of things. It speaks to the fact that we don't want to overpay for something, right? We're going to stick to our metrics, and I'll show you guys that. As our potential investor, the most important thing is protecting your money and making sure that we don't overpay, and that impact or that purchase price can really affect long-term returns. So it's like compound interest, right? It really starts to build, and if you don't model it right, if you don't buy it right, it's really going to be an issue. So let's talk about Tucson here for a sec. Why Tucson? Some of you don't even know Tucson very well, but really it's an hour and a half south of Phoenix, about 90 miles. And there's a million people there, so it's a very actually good sized city. It's the baby brother, right, to Phoenix. $52,000 median income, and there has been a boom in all of Arizona, really. But Phoenix has seen a massive growth, but Tucson has actually done really, really well relative to other markets, other large MSAs across the country. And when I use the word MSA, so that's Metropolitan Statistical Area, MSA. And the Tucson MSA has, it mimics Phoenix really well. And so the couple things that we like to look at, average earnings and population growth and job growth. And so if you look down here very quickly, you could see that, there's a wide diversity of employment by sector. There's a lot going on as far as, we like to see well-insulated markets. It's really important. So once we kind of figure that out, then we look at, what does the rent situation look like? Is there an increase in rent? Is it really flat? I'll give you an example. Tulsa, Oklahoma, beautiful city, lots of families, lots of good growth, but not a lot of rent growth. It's almost been flat, between 1.5% and 2% growth. And if you factor inflation in, it's really been flat. And so we like to see 4, 5, 6, 7% rent growth, because when we take over a property, the goal is to improve it and make sure we can meet that market rent growth, but then also the market should appreciate somewhat. That is how we provide a nice return for our investors, right? So here's a cool stat. Tucson in Q2 of this year, so very fresh data, in the middle of COVID, actually led the country in rent growth at 3.8%. So while, cities like San Francisco were actually shrinking, Tucson hit number 1, Phoenix actually hit number 2, and Albuquerque was number 4. And even though I just finished telling you it's also hasn't seen rent growth, it hadn't seen rent growth in a while. So it's been nice to kind of see a little bit of that growth that's starting to happen. And that's because there's been more employers that have moved in there. So there's a lot of other data on here. I won't speak too much of it, but really there's a couple things, right? Nice rent growth. There's affordability factor. So if you think about, other areas, cost of living is still relatively low, and that really helps with overall opportunity. The other thing we like to look at is occupancy rate. So, is there an overbuild of buildings? Meaning there's when their occupancy right now is about 95%, 95, 96%, and you want to see that remain fairly steady. What happens is if they build a lot of new properties, right, new deliveries, what they're called, do you have enough people being able to fill those, right? And so if you have not enough people, you don't have a good absorption rate. If you look here very quickly, 255 delivered, 310 absorbed. That means more people moved in to the marketplace and fill those units than were actually available, right? And that helps keep occupancy high. So that's really important. Overall, again, lifestyle entertainment. This is a young professional type of market. Yes, there's lots of families down there, but when you look at the types of employers, there's tech, there's healthcare, and obviously there's university, not just students, but also, the teaching staff population. So it's a slightly different employment type. Employers are actually pretty broad, but as far as the demographic, we're looking between 20 and 45, 50 years old is really the core demographic. Here's a quick shot of some of the employers that are in the marketplace. So U of A, largest employer in town, Raytheon, Pima County government, the Air Force Base, and then you have a good chunk of retail, mining, and other tech. So it's a broad spectrum, which gives good insulation when there is a downturn, because that way we know that the entire city doesn't collapse. Example, Las Vegas potentially, right, took a pretty big hit a couple months ago because everything really shut down because it's very focused on service and retail. Okay, so again, a little bit more data, and I'll kind of pause here, but this looks at the future opportunities, future growth. There is basically an increase in jobs, and this talks about market risk. So what jobs are higher risk? So if you look at the breakdown, it's a smaller percentage. So I just talked about service jobs being highly risky in all kinds of economic conditions, but service ends up being one of those areas. So 19%. So out of the full population, you have other types of jobs that are well insulated during downturns. So that's really important. That looks at a long-term picture. Then you look at overall construction, what's moving in, lots of employment, lots of development in healthcare and education. So you're going to continue to see there's actually a really nice collaboration with University of Phoenix and Banner Health and a few other medical health companies that are working with the university to develop research parks. And those are high-paying jobs. They talk a lot about, it speaks a lot to, again, long-term interest in being in the marketplace. So let's talk about the property. This is it is a pretty cool property. It's 140 units, built in 1985, renovated fairly completely in 2015. Here's kind of a nice overshot of it. And you'll hear me kind of talk about these kinds of properties. We're talking about a garden style property. So you'll see here, it's 2 stories. There's several buildings on it. We're not really into the high-rise apartment space. There's some extra liability there and just more cost. These are easier to maintain. It's not to say that we wouldn't go after, a 7-8 story tower apartment building, but we like this style. It also helps us from a pricing standpoint because these types of buildings are older. Now they're building them, more vertical, and so there's a higher price tag. So this would be classified as a B+ to C+ type of property in this kind of construction style in this era. Overall acreage, it's average size of the units is about 500 square feet, and so it's on the smaller side. There's a mix of 1-bedroom and 2-bedroom units. I believe it's 108 1-bedroom units. You can see that data down here, and 32 2-bedroom units. So nice overview of the courtyard. Actually, we had plans to kind of blow this up and make this, not so much the trees, but make this a really nice space for families, put a few more pergolas. There's a volleyball court they can't see right here that we wanted to turn into like cornhole and a barbecue area. That would have been really cool to do. So these screenshots that you're seeing are essentially from a piece of a document called an OM, an offering memorandum. And so every deal that we look into, we sign a confidentiality agreement. We get that data. This is one of them that we get. And, it's important to remember that, you got to take some of these figures, and this is the pro forma, the financial data, with a grain of salt. This is a selling tool. It's a marketing tool. So the data could be potentially, improved in certain areas and maybe reduced in other areas to make the overall number look better. But we take this with one piece, and then we also look at the T12s, which is the trailing 12-month financials, P&L, profit and loss statements. And then we also look at the rent roll, which is a breakdown of every tenant, when they moved in, how much they pay, if they owe back rent. And usually we get a couple of months of that data. That really helps us kind of paint the picture of what is the property currently doing. And when we go to acquire these kinds of places, we really want to see today what is happening today in the apartment. So here's a cool shot of the clubhouse area. Actually, this is the leasing office right there. There's an open kitchen. There's a gym. There's that volleyball court that's pretty beat up that we wanted to improve. Here's a overview from the top of all the buildings. You can see the breakdown, and there's plenty of ample parking here. And when we walk the property, I mean, again, very well maintained. There's something called deferred maintenance. So if you look at deferred maintenance, that's like overgrown trees, potentially water issues running down the building. And even though it doesn't rain much in Arizona, when we do get monsoonal rains, it can really wreak some havoc. One of the buildings actually had the roof torn out, and so they had to get that replaced. And those are all things that could come up, will come up, and you just need to be aware of what to look for. A nice overview of the actual apartments, kind of sky view, what they look like. Like I said, it's two types of one bedrooms and a two bedroom. And we like to see a nice mix of that. Tucson specifically doesn't have a lot of two bedrooms. It's mostly built with a lot of one bedrooms or studios, but we definitely like to have the two bedroom. It creates typically a more stable tenant because they might have families. It's a couple, young family, whatever that scenario is, we like to see that help balance it. And then young professionals are typically in the one bedroom. When you have a lot of studios, it can really drive a lot more turnover because you might have more transient type of tenant base. So that's something we look at. Okay, transitioning to the business plan and CapEx overview, capital expenditure. As you can see here, we had a very just basic plan to keep the existing property manager in place for at least a 6-month trial run, give them the opportunity to really make the improvements. They hadn't been able to do that under previous ownership. From a rent increase schedule, this is how we make money, how we create value. We think we could have done an immediate $20 a door without any kind of renovation work on the one bedrooms. That annualizes to $25,000 a year, $50 on the two bedrooms. And then once we made the improvements, another $100 per unit after renovations, really focused on the two bedrooms. So that would have created an additional $2 million in value creation over 2.5 years. From an operational standpoint, we wanted to really focus on the tenant experience. Again, give them the fob access for some outdoor usage, improve the pool area, and that courtyard that we talked about. This is the CapEx schedule here, and just kind of a rundown. I kind of talked about the overall purchase price, but we knew it was renovated, but we can have come in now and make significant improvements to the rest of the units that weren't done. This is kind of the breakdown from flooring, fixtures, cabinets, bathrooms. That courtyard, we budgeted around $40,000 to make that improvement. Reseal the roofs, update the rest of the AC units, pool pumps, full paint job, and that laundry upgrade, which was going to be 3 years down the road, but we wanted to work on that in advance. Total CapEx budget was $1 million, just a little over $1 million, or $7,600 per unit, and it would have taken about 24 to 30 months to really capture all of that benefit. So this is something we do on every single property that we get this deep into, and that helps us kind of think through what's the process look like. And once the plan is set, we win the property, and we have our team immediately ready to go. And so appreciate the opportunity to share this with you guys. If you have questions, comments, please comment. Thank you.